China's very dangerous fiat currency and credit situation. With all the China news that has been coming out in the last 6 to 12 months, or early this morning, the Chinese government allowed the RMB to blow past the 7 exchange rate against the dollar. And also, hedge fund manager Kyle Bass said today on a Yahoo Finance interview that the Chinese financial system now has over $53 trillion worth of credit. I decided that I should do this update with charts and graphs to show to the China bulls who are adamant, who have closed minds, who do not have open minds. They believe that because China owns a lot of gold, that China does not have a debt problem or that it doesn't matter. So first, let me say that I think one of the overarching themes about China is China's financial situation. Things have changed a lot in China in the last decade. So the nation's total stock of corporate, household, and government debt now exceeds 303% of gross domestic product and makes up about 15% of all global debt, according to a report published by the Institute of International Finance early in 2019. That's up from just under 297% in the first quarter of 2018. I've covered this in a live stream show a few months ago, but everything is together and there's a lot more good charts and graphs that will prove my point. This is a chart of China's M0 money supply, which is just cash and coins in China's economy. So the amount of cash and coins in China's economy has gone up over sevenfold in base money since the late 1990s. That is a lot. And the way things work in a banking system with fractional reserve lending is that once there's base money, once there's checking accounts and savings accounts and reserves, the banks can then start to do massive amounts of fractional reserve lending with it and lever up a lot. So this is a chart of China's M1 and year-over-year growth rate. So China's M1, what I would view when China's M1 collapses like that is I have two theories about this. So number one, the savings rate in China could be collapsing. And number two, there could be a lot of Chinese people who had money in the bank and are pulling it out. And this would make sense with what's going on now with the RMB against the dollar, the exchange rate doing what it is, and with the trade war escalating, how people who had money in Chinese checking accounts, savings accounts, etc. And M1 is mostly just cash and checking accounts. M2, I think, is a more broader money supply and includes more time deposits if you're not familiar with the M0, M1, M2. And I would say that the decrease in M1, a lot of it probably has to do with the fact that a lot of Chinese who had money in the bank have been pulling it out. They do not trust the RMB. They are pulling money out of their checking account, and they are using it to buy physical precious metals, probably gold and silver, and then also Bitcoin. Any way they can to get their savings out of RMB because of this escalating trade war. The real economy in China is not doing as well as the government statistics say. We know that China posted the worst GDP in 27 years, and a lot of people do not trust Chinese economic data. Not that any of these governments have accurate economic data, but China's economic data is even more fraudulent than a lot of other countries. This is China's M2 growth. Pulled this from tradingeconomics.com. China's M2 growth rate is over 8% compound annual growth rate starting at 2008. You can see here on the chart that things are not going up very quickly until around 2008. And we'll talk about that. So China really did not have a debt problem at all, really. They had some debt, but it was nowhere near the levels that it is now. And it's at astronomical levels, and it's pervasive throughout all levels of society, unlike what Peter Schiff and the China bulls are saying. This is from the Institute of International Finance, this slide. This slide is not through 2019, but it proves my point that there was very few trillions of dollars in total debt in the Chinese economy prior to 2008. The real big ramp up, and you can see here on this chart where I circled it, is it really starts to go crazy up to almost 40 trillion in about a decade. And a lot of it is from non-financial corporates. But there is growth in other parts of the debt, especially household too. This is a chart from Bloomberg from about a month ago. So China's local corporate bond delinquencies rose in June amid market jitters. So China had a record amount of private sector corporate bond defaults in 2018. And 2019 is also a lot as well, as you can see there from the chart. So there are a lot of corporate bond delinquencies rising in June and July, and it's probably going to keep getting worse, as we've seen with more of the current event stories from Baoshan Bank, Bank of Jinzhou, and some of these other Chinese management companies. There's a number of them that have been covered by the mainstream press that I also mentioned. A lot of these money management companies on previous live stream shows in my China coverage. This summarizes some of the main things going on in China's private sector, their corporate debt defaults. So there was record private sector corporate debt defaults in 2018. The 2019 pace is also very high, as even some Chinese billionaires are now defaulting on their debts. There was a recent Wall Street Journal article detailing this. I have the screenshot of the article if you want to read it. It'll be later in this presentation. The dollar-denominated debt in China has increased massively. I've covered this as well. And the People's Bank of China, which is China's central bank, cannot bail out and print over all the dollar-denominated debt. So China has tough decisions to make about what to do with the companies, the banks, and the private sector companies and the state-owned enterprises that have too much dollar-denominated debt. So they cannot just print RMB to deal with dollar-denominated debt. They can print RMB to deal with RMB debt or wipe that debt out one way or another, or a haircut. They've been doing different things lately, whether it was a full takeover of Baoshan Bank and then a haircut to some of the creditors. And then with Bank of Jinzhou, what they did was more of a Bear Stearns style takeover, where they engineered one of China's two largest banks to buy a large stake, and some of China's debt companies that buy riskier debt to buy equity in Bank of Jinzhou. So they've created, and this is the crazy part about China, they've created over $40 trillion worth of credit since 2008. Kyle Bass says it's 50 trillion now. He just did an interview today talking about this. If you listen to my interview with Denny McMahon, author of China's Great Wall of Debt, he goes into depth in his book too, besides just my interview. There's more in-depth analysis and him actually speaking with government officials and people who got contracts in China from local government finance vehicles. These are where these local governments actually opened up a dummy corporation to borrow money from banks. So local government finance vehicles went on enormous borrowing binge in the last decade as well. And they're still doing it from what I've heard. Much larger housing bubble than the one in the US. There's a lot of similarities, although I would say that the Chinese housing bubble is somewhat different, because now there's a lot of what's considered an investment, in air quotes, I would say now, is Chinese people taking out mortgages and buying empty concrete shells and hoping for higher prices. So they're not taking out mortgages to get cash flow on a property and have it rented out that's furnished. They're not doing that. They're expecting higher prices. They have very similar mindset to the US housing bubble from 2002 to 2007. Remember, Ben Bernanke went on CNBC and said that housing prices never fall, and along those lines, subprime is contained, stuff like that. And that's a very similar mindset to the real estate investments in China. And China's real estate bubble may be a lot larger than 5 times the size of the one in the US that popped in 2007 and 2008. So there's a lot of research on this. There's over 50 million empty houses and still building in China. One of my sources in China says the building won't stop until basically the currency collapses, that it's part of policy. So basically it's make work jobs programs. As long as some credit's available, they're going to keep building. So there's over 50 million empty houses. A lot of these houses are not built up to code like in the United States. They're empty. Some of them are made with bad construction materials. Some of them are falling apart pretty quickly as soon as they're built, or they're unfinished. It's a mess, but it's still ongoing. I would call this, as an Austrian school economist, massive misallocations of capital. So China's banking and shadow lending system, according to hedge fund manager Kyle Bass, China's banking system is leveraged 20-1. This assumes that the assets don't dramatically fall in price. So the US banks and Ben Bernanke, the Bernanke Fed, made this bad assumption too, because they leveraged up, and you had banks like Bear Stearns that was leveraged 60-1, a 2% drop in their asset prices, and they were in trouble. They were insolvent. Lehman Brothers was leveraged at 40-1. So a 2.5% drop in Lehman Brothers asset prices, and they were insolvent. So Bear Stearns couldn't even afford a 2% drop in asset prices at 60-1, and Lehman Brothers couldn't even afford a 3% drop in asset prices due to the leverage that they were using. Counterparty risk has exploded post Baoshan Bank. the bailout or takeover by the People's Bank of China. And remember, the creditors were not made whole. People in China expect full bailouts, and a lot of the creditors of Baoshang Bank, some of them got up to 30% haircuts, which was surprising and shocked a lot of people. And that sent aftershocks and reverberations throughout the Chinese banking system. Also, the non-banking financials like the money management companies and the interbank lending markets. So Chinese lenders have been demanding higher quality and higher quantity of collateral now, but still lots of bad collateral throughout the system. So Denny McMahon talked about this in my interview with him from China's Great Wall of Debt, and he compared Chinese banks to pawn shops with respect to how the companies will take almost any collateral as long as they think that they can sell it for value, and they were willing to give a loan to almost anyone who had collateral. So what that means is, and if you read Denny McMahon's book, he goes into this in depth with his research and visiting like Chinese factory owners. There was a number of Chinese factory owners that knew nothing about real estate, and they put down collateral, got loans from banks, and were all of a sudden in real estate and speculating in real estate and building in construction. They knew nothing about those businesses, but because they had collateral, they put it down, and the banks gave them the loans. Meanwhile, then the odds of the company doing well, the real estate company, with someone who doesn't have business experience in real estate is very, very low. So these things were doomed for failure, and yet the Chinese banks gave out many billions of dollars, if not trillions of dollars, of loans to people like this. The Chinese interbank lending had enormous spike. Zero Hedge covered this. There was an extensive article in the last month or so. So one of China's two largest banks, ICBC, had to help intervene with a Bear Stearns-style takeover, a bank of Jinzhou, to lower counterparty risk and contagion fears. And another one of China's two largest banks, CCB, gave out $291 billion over 5 years they've committed to in financing support. It's called financing support instead of a bailout to Hunan province. So this just proves the misallocations of capital, the waste, fraud, corruption, and abuse in the provincial level and the local government level. These local government finance vehicles, I talked about a story about Hunan province, how multiple cities were borrowing way too much money and couldn't pay any of their city workers. This is a chart that shows how much the corporate debt has exploded in China. So the corporate debt was near zero in 2005, 2006, 2007. And within about 10 to 12 years, it just went parabolic. It just went super high up. Now, it doesn't have 2019 on here, but this shows you the point that I'm making, that things have changed a lot in the last decade because China didn't have a debt problem really in 2008. Look at that chart. So China did not have any debt, really, very, very little debt. They certainly didn't have a credit bubble. They certainly didn't have a real estate bubble prior to the last 10 years. I think this chart does a great job of illustrating it, even though it's not up to date at 2019. This is one of the articles I was talking about. This is a Wall Street Journal article that came out about a month ago. Heavy debt humbles China's business champions, including the jewelry queen. So there's a number of Chinese billionaires that are talked about in this article who were leveraging up their business to build, either expand their business, and they stopped having success with that, or they put the collateral down, like Denny McMahon said. They put the collateral down to start getting into the real estate business, and guess what? They didn't have any real estate experience. So they're close to default or have already started defaulting on billions of dollars in bonds. A lot of it is dollar-denominated debt. The People's Bank of China can't help them really with that. This shows the credit binge, the percent of GDP. This is for household debt. So Peter Schiff and many other China bulls, especially China bulls in the gold community, will say that China has lots of savings. China has no debt. There is no debt problem in China. There is no credit bubble in China. There is no housing bubble in China. Well, look at how much the debt has gone up in the last 10 years for household debt. It's gone up a lot. 10 years ago, Peter Schiff was right. Now, not so much. Things have changed a lot. This talks about the amount of percentage. So household debt in China increased to 52.6% of GDP in the fourth quarter of 2018. And it was 30.69% of GDP from 2006 until 2018, almost doubled in a decade. And in 2006, it was a low of 10.8%. So I think these charts, the last two charts about increases in household debt are showing you guys how much it has increased. And the China bulls will have none of it. China owns gold. China has savings. China manufactures lots of things. China is in way better shape than everyone else. That is the narrative. And they just ignore facts, figures, stories. It doesn't matter to them about any of the stuff I'm saying. This is another story that just came out in the last week or so from Bloomberg. China's Generation Z is hooked on credit. And this story talks about a lot of millennials and college graduates in China, and they're up to their eyeballs. So they didn't necessarily have student loans, but they've been getting into peer-to-peer lending schemes, and they've been wasting money, accruing debt on video games within video games and computer games. So there is a growing debt problem. I'm trying to point this out, that with the charts for household debt and the story about the millennials here, also the corporate debt and the debt defaults, the amount of corporate debt that has increased and the debt defaults, there is a lot more debt pervasive throughout Chinese society than there was 10 years ago. So anyone who says that things are the same as they were 10 years ago in China doesn't know what they're talking about. This is another chart. Now, it's not up to date in 2019, but it shows you the sharp rise amid easier policy stance in financial sector debt and government debt. It's increasing. And this is because the Chinese government, starting around 2006, 7, 8, and then ramping up in 2008, 9, 10, lots of stimulus, lots of quantitative easing. The money and credit bubble started. This is very interesting because it shows how much of each part of China's economy has increased in debt. Now, this isn't up to date on 2019, but it gives you a good reference point to see how much Chinese debt has increased. So it was barely at 150% of GDP in 2000, the total, and now it's doubled. So China's getting to those levels of all the unfunded liabilities in the US, the European Union, Japan. China was not at those levels 10 years ago or 20 years ago. It just wasn't. And things have gone crazy in the last 10 years. But it says here the biggest increase in debt was in non-financial corporations. And that's what happened with China's shadow banking system, their credit bubble, their real estate bubble. You had companies that knew nothing about real estate. They couldn't make money in their business anymore in the last 5 to 7 years, and they went into real estate. Are you telling me that that's sustainable? That real estate prices don't go down? This is a Bloomberg slide that came out last month, and the big explosion is in non-financial corporates that has increased. It's the largest percentage. So that would make a lot of sense. I've been talking about this, but they're saying that according to their calculations, and people calculate debt to GDP differently. Remember, I talked about debt to GDP earlier in this presentation here, that China's total debt to GDP ratio now is closer to 310% as of July 2019. This is showing how much leverage ratios and debt increases from non-financial firms and households. Look how small household debt was in 2008. It's a lot larger now. And China's non-financial firms, the debt ratio is a lot larger too. But the largest increase here on the chart, I mean, non-financial firms really have been growing bigger since 2008, but the household debt has gone a lot larger here. That's what I noticed the most. Government debt seems fairly steady. It didn't increase a lot, but you got to remember, though, with the government debt on here, that's not counting the local government finance vehicles. So the LGFVs are being counted as private companies. They're not normally they're dummy corporations that were set up by the local governments, and they're not counted as government debt. And there's many trillions of dollars in credit that these local government finance vehicles took out. There's been famous investor comments about China. Jim Chanos was warning people in 2009. He was wrong. He screwed up the timing of things. He didn't understand how long the credit bubble could go for, how long the real estate bubble could go for before China could get in any trouble. And I think I forgot to mention this earlier in the video, but I think one of the important points here with China getting 300% debt to GDP ratio is that their economy is, to use a scientific term, super saturated with debt now, where adding more marginal debt and more marginal credit will not create GDP. We've seen this with the GDP number, so it will not help China to add a lot more credit, to add a lot more debt. They're not getting that bang for the buck with their GDP growth anymore. And what that tells me is that their economy really cannot take much more credit and debt. It's very dangerous. So the Chinese government can try to do quantitative easing. They can try to do these stimulus tools or other policy tools, but it looks like they're headed towards Japanification as well. So Jim Chanos in 2009, he said China's current economic success is a mirage since it's dependent on plentiful supplies of cheap credit. Chanos warned that when these supplies dried up, China's multiple asset price bubbles will burst and it will be Dubai times 1,000 or worse. Jim Chanos may ultimately be proven right. However, he was totally wrong on the timing. He was at least 7 to 10 years off because he was, besides 2009, he was saying 2010, he was saying this, 2011. I think by 2012 or 2013, he just gave up. So he was off on his timing, even though a lot of his points were valid. He just didn't think that it was fathomable for China to increase credit by over 40 trillion, to go to over 300% debt to GDP, to build over 50 million empty houses and counting, things like that. And David Stockman in 2016 wrote an article called Red Ponzi Ticking. So it's a very long, in-depth article going through the history of China. And remember, David Stockman worked in the Reagan administration, so he would know some of the intelligence that was had on China. He also worked on Wall Street. And quote, China, and David Stockman refers to China as Red Ponzi frequently, is not a 10 trillion growth miracle with transition challenges. It is a quasi-totalitarian nation gone mad, digging, building, borrowing, spending, and speculating in a magnitude that has no historical parallel. The PBOC's red-hot printing press, in turn, emitted high-powered credit fuel. In the mid-1990s, China had about 500 billion of public and private credit outstanding, hardly 1 times its rickety GDP. Today, that number is 30 trillion or more. So remember that this quote was from 2016, so China's credit has kept increasing, and Kyle Bass says it's now over 50 trillion. So according to many estimates, China's debt to GDP ratio is already over 300%. China's economy is slowing down as evidenced by its worst GDP in over 27 years, and the GDP is definitely fake. How fake is it? There was a Chinese professor who in December of 2018, he ran the numbers himself inside China, and he said that the GDP was below 2%. It was trending a lot faster downwards, and it was heading towards 1. And I hope the guy's okay. Let me just put it that way. Because there is no free speech in China. Recent articles coming out about Chinese billionaires defaulting on debt, articles about Chinese millennials in debt now, and also those charts I showed you about how much Chinese household debt has increased. Mortgage, credit card, auto loan debt have risen a lot in China. Record private sector Chinese corporate defaults in 2018, and the 2019 pace is also very high. And there are trillions of dollar-denominated debt also borrowed in China. And remember that they cannot just print it away. I don't even know if the Chinese know how they're going to deal with it. And China needs dollars to buy food and energy to import them. So one of the main reasons that China's economy is slowing down is because there's already too much debt pervasive throughout all levels of Chinese society. So can the Chinese economy handle more debt and credit growth? And I think the answer is probably no. I do not think the Chinese economy can handle much more debt and credit growth, and even the money supply. The money supply has already gone up a lot, and we're seeing evidence that a lot of people inside mainland China do not want to hold the RMB. They want to hold gold. They're even willing to use Bitcoin as an intermediary to get around those capital controls, those $50,000 per year capital controls, and get their money out of the country into either other currencies or real estate or gold. So here's a conclusion. China's economic boom was not a miracle. It was textbook central planning with tens of trillions in new fiat currency and credit created in only a decade and trillions in misallocated resources. Credit booms eventually go bust. Is the best case scenario Japan? Japanification for China too. China's economy adding more debt and credit does not produce as much beneficial GDP anymore, the worst GDP in 27 years in second quarter 2019, and over 300% total debt to GDP ratio, as debt is now pervasive in the local government finance vehicles, Chinese corporations, and also now in the household sector. How will China deal with an escalating trade war with the US, a current account deficit, as Kyle Bass and other experts like Daniel Lacalle have also highlighted, a real estate bubble and tens of trillions in bad loans? And the dollar-denominated debt cannot be printed away by the People's Bank of China. Lots of people who are China bulls and in the gold community refuse to acknowledge this. They say China's debt doesn't matter. They don't have a debt problem. China has gold, and the debt can just be wiped away because China has gold, or China will just print away the debt, and then they'll be left with their gold. Will China running twin deficits result in a currency crisis, or will their gold save them? Does China have a dollar shortage? Will the dollar peg break? So I think these are all valid questions, and I don't hate China. I just think that a lot of people, especially in the gold community, especially in the alternative media, and a lot of people in the mainstream media too, don't fairly cover China. I think there's a lot of bias. There's a lot of pro-China bias. There's a lot of China bulls, especially in the gold community. Okay, just because China's buying gold does not mean their economy is great. Does not mean they can't collapse. There's a lot of questions that have to be answered about China's future, especially with this escalating trade war. Because I think, unfortunately, now it's going to get a lot worse before it gets better. And lastly, I spent over 8 hours of work putting this all together, making the slide deck, finding the charts and graphs, writing out some of these slides with bullet points, finding the articles, and then recording the audio, editing it, and putting together a presentation for you guys to really drive things down and give you a better perspective that China has very serious problems with their fiat currency and credit system now, and that a lot of things have changed in China in the last decade. If you don't agree with me, fine. I presented you with a lot of the facts and figures and charts. There's a lot of financial professionals that agree with me, though. Although I think very few people in the gold community agree with me. I think the narrative is that China is good, the US is bad. China buys gold, that means they're good. Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street for Main Street YouTube channel if you have not already done so. Thanks for helping Wall Street for Main Street pass the 20,000 YouTube channel subscriber milestone despite YouTube censorship. Hopefully, we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down this channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street for Main Street email list that's on the wallstreetformainstreet.com website and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to wallstreetformainstreet.com. That's wallstreetformainst.com website, where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing my loyal listeners with some of the best information, analysis, and financial education available out there, free or paid, as I work to grow the podcast and also get my educational technology company funded.